January 28, 1971 is remembered as a technical adjustment, but in reality it marked a structural rupture. On that day, the United States quietly began the final steps away from the Bretton Woods system, a framework that had anchored global currencies to gold since the end of World War II. By August of that year, the dollar's convertibility into gold was formally suspended. What followed was not chaos, but something more subtle and more permanent. The world transitioned from a system disciplined by reserves to one governed by confidence, credibility, and balance sheets. That shift did not collapse markets overnight. It altered incentives, slowly and methodically, in ways that still define the present moment. The mechanism most people overlook is not inflation itself, but the structure that allows it to persist without immediate consequence. Once currencies are no longer constrained by a hard asset, the limiting factor becomes trust. Governments can expand deficits, central banks can expand balance sheets, and markets can absorb the shock as long as confidence holds. The signal of stress does not appear first in consumer prices or equity indices. It appears in relative assets, in spreads, in ratios, and in the quiet repricing of what is considered a store of value versus what is merely a claim. History offers repeated examples of this pattern. In the late Roman Empire, silver denarius coins were gradually debased, not as an act of collapse but as a fiscal solution. For decades, the empire functioned. Trade continued, armies were paid, and markets adapted. The damage only became obvious later when confidence fractured and real assets began to replace coinage and settlement. In 16th century Spain, the influx of New World silver expanded monetary supply dramatically. Prices rose, but more importantly, productive capacity lagged behind financial claims. The empire mistook temporary abundance for structural strength, and the adjustment came through stagnation rather than sudden ruin. In the 20th century, the British pound followed a similar arc. After World War II, sterling remained a reserve currency by habit and prestige, even as debt mounted and industrial capacity eroded. The belief that status could outlast structure delayed reform, but it did not prevent decline. These episodes share a sequence that feels almost mechanical. First comes flexibility, introduced as a solution to crisis. Then comes normalization, where extraordinary measures become routine. Then comes divergence, where financial claims grow faster than real output. Finally comes repricing, not through a single event, but through persistent shifts in behavior. Capital moves differently. Hedging replaces investment. Preservation replaces growth. In the modern system, the US dollar sits at the center of this structure. It is not merely a currency, but a unit of account for global trade, debt, and reserves. That position grants extraordinary privilege, but it also creates fragility. When deficits expand and policy choices prioritize short-term stability over long-term balance, the cost is not paid immediately. It is distributed across time and across holders of the currency. The pressure shows up first in assets that do not rely on promises. Gold and silver do not generate yield, but they also do not depend on policy credibility. When they rise alongside strong equity markets, it is not a contradiction. It is a signal that different parts of the system are responding to different risks. This is where the hidden pattern becomes visible. The dollar does not collapse in a straight line. It weakens in relative terms, pauses during fear-driven rallies, and resumes erosion through purchasing power rather than headline exchange rates. This is why focusing on dramatic predictions misses the point. The system does not announce its stress. It reveals it through correlations breaking down and through assets that begin to behave as insurance rather than speculation. By the early 2000s, this dynamic was already in motion. The expansion of credit after the dot-com bust normalized intervention. The 2008 financial crisis institutionalized it. Balance sheets that were once emergency tools became permanent features. Each intervention stabilized the present while borrowing stability from the future. At each stage, policymakers believed the system had evolved, that safeguards were stronger, that models were better, and at each stage, incentives quietly shifted toward greater leverage and lower tolerance for correction. This brings us to the present configuration, where the dollar, commodities, and yields form a tightly linked triangle. When yields rise due to inflation pressure, the currency can strengthen temporarily, but confidence weakens. When yields fall due to growth concerns, the currency can also strengthen, but only as a reflex, not as validation. In both cases, the underlying issue remains unresolved. The system requires constant expansion to remain stable, and stability itself becomes dependent on intervention. Gold's behavior in this environment is not anomalous. It is consistent with previous late-cycle adjustments. In the 1970s, after the end of Bretton Woods, gold did not peak immediately. It consolidated, broke out, corrected, and then entered a prolonged revaluation as the market recalibrated what an unconstrained currency regime implied. In the 1930s, after the U.S. revalued gold from $20.67 to $35 an ounce, the move was not about speculation. It was about restoring balance sheets and resetting trust. Each time, the metal's role shifted from commodity to reference point. Silver follows a related but distinct path. Historically, silver has lagged gold in the early stages of monetary repricing and then accelerated sharply as participation broadens. This occurred during the late 1970s, when silver's industrial demand and monetary role converged, and again in smaller cycles where liquidity conditions tightened. The volatility is not incidental. It reflects a thinner market reacting to structural rather than narrative forces. As Part 1 closes, the pattern is clear but incomplete. The system has entered a phase where traditional signals no longer align cleanly. Strength in equities does not negate stress in currencies. Rising metals do not require immediate crisis. They indicate adjustment. The question is no longer whether the structure will change, but how the transition unfolds and which mechanisms absorb the pressure first. That question becomes more complex when capital allocation is examined at the institutional level. Pension funds, sovereign wealth funds, and insurance pools are not designed to trade narratives. They operate on models built for a world where bonds offset equity risk and where currency stability could be assumed. When those assumptions weaken, allocation rules, not opinions, begin to shift. Even marginal changes in those rules can have outsized effects in markets that are structurally small, such as commodities and mining equities. This dynamic has historical precedent as well. In the late 1960s, U.S. pension funds began modest diversification into real assets as inflation pressures emerged. The flows were small relative to total capital, but the markets they entered were smaller still. The result was not immediate instability, but persistent repricing. In Japan during the 1980s, institutional confidence in perpetual growth delayed adjustment. But once balance sheet constraints tightened, capital retreated rapidly, leaving asset prices detached from prior assumptions for decades. The lesson is consistent. Large systems do not turn quickly, but when they do, they move with force. Mining equities occupy a particular position in this structure. They are claims on real assets, but they trade within financial markets. Their costs are tied to energy and labor, while their revenues are tied to global pricing. In periods of monetary adjustment, this dual exposure amplifies outcomes. During the early 2000s commodity cycle, miners underperformed initially as capital hesitated. Once allocation models shifted, valuations expanded rapidly, only to contract sharply when liquidity tightened in 2008. The assets themselves did not change. The framework through which they were valued did. Oil's role in this environment is often misunderstood. It is not merely a commodity, but an input into every productive process. When oil prices remain subdued despite geopolitical and fiscal stress, it reflects demand uncertainty rather than abundance. Historically, such periods have preceded repricing not because scarcity emerges suddenly, but because inventories and assumptions prove fragile under pressure. The oil shocks of the 1970s followed years of complacency. The spike was the symptom, not the cause. The same structural logic applies to uranium, coal, and platinum. These markets are shaped by policy, infrastructure timelines, and supply constraints that do not respond quickly to price signals. When demand shifts due to strategic considerations rather than cyclical growth, repricing can be abrupt. This has occurred repeatedly from the rare earths episode in the early 2010s to the energy security concerns that followed the 2022 supply disruptions. In each case, the trigger was not speculation, but a reassessment of reliability. Throughout these cycles, the prevailing belief among dominant institutions has been that adaptation equals immunity. Better models, faster data, and coordinated policy are assumed to neutralize historical risks. Yet history suggests the opposite. Complexity often delays recognition rather than preventing imbalance. The more layers added to stabilize the system, the more pathways exist for stress to migrate rather than dissipate. The dollar's position reinforces this tendency. As long as it remains central to trade and reserves, its adjustment can be gradual. That gradualism is often mistaken for strength. In reality, it reflects distribution. Purchasing power erosion, asset inflation, and portfolio hedging spread the cost across participants. The system continues to function, but its internal ratios shift. What was once considered conservative becomes exposed. What was once considered speculative becomes defensive. This is why the current environment feels stable and uneasy at the same time. There is no single catalyst required. The mechanism is already active. Reform remains possible, but it requires alignment between fiscal discipline, monetary restraint, and political tolerance for short-term pain. History offers few examples where such alignment occurred without crisis forcing it. The more common outcome is incremental adjustment punctuated by moments of recognition. As the cycle progresses, the unsettling truth is not that collapse is imminent, but that normalization may never return to prior definitions. Systems built on confidence do not fail when confidence dips. They fail when confidence is redirected. The narrow path forward lies in acknowledging constraints before markets impose them. Whether that path is taken remains uncertain. What is not uncertain is that the structure will continue to adjust quietly until it no longer can.